Welcome back, everyone. January was a banner month on Wall Street. Now, is it a true sign that our economy is on the road to recovery? That is the subject of tonight's On the Money segment. Joining us to talk about it is financial planner Jan Tinhagen of the Huntington-based Tinhagen Financial Group. Welcome back. Obviously, a regular contributor here on News 12.
Thank you.
Okay, so I was looking at some of the numbers. The NASDAQ up 8% in January, Dow up 3.4%, S&P up over 4%. The best January since 1997.
Right.
15-year stretch. I mean, but does that necessarily translate into a good year?
Not necessarily, no. It just happens to be one good run, which is great, better than a bad run. But again, you've got to be in the market for the long term and be spread out across the whole thing. Okay,
so what should we be looking at globally and nationally for this year as to what is going to be good for us?
Well, the U.S. has some very, very strong earnings, and people are starting to stop focusing on Europe and Greece and the rest of them over there. Greece and Germany are starting to figure out, okay, we really got to settle this thing at some point. So now we're focusing on the U.S. and the earnings per share in most companies is doing very, very well.
So do you think the stock market, as Europe tumbles back and forth, and I mean the UK right now, some people are saying their economy is even worse than it was after the austerity measures have taken place. Is it not affecting the stock market as much as it was before?
Correct. It's not. Okay. No. This market is focusing on itself, and there are good earnings out there. If you look at companies with good dividends, which is always what you should look at for a majority of your portfolio, there's some really good ones out there.
Okay. Let me ask you this. The payroll tax credit, that's coming up pretty soon. Right. That could be potentially a tax hike for many middle-class Americans. Is that something that could affect the market?
It could affect the market with people perhaps not putting as much away as they could before. But no, I don't think it's going to affect the market.
Okay. What should we be looking for then?
At this point?
At this point.
I would look for companies with good earnings, with good dividends, with good fundamentals. What's a company that's going to grow? You know, you've got to brush your teeth, you've got to comb your hair, you've got to take the kids to school, you've got to drive your car. All of these things require payments of some sort. Those are the kind of companies to look at, the good, solid base companies.
What about tech companies right now? I mean, Facebook is just about to start its IPO, going public, hoping to raise $5 billion. Are tech companies something that we should be looking at this year? Well,
it's more of an informational tech company rather than a product tech company. I would stay away from tech right now because with the tsunami last year, you still have some breaks in supply, et cetera. So I would look at telecommunications. Because tell me somebody that doesn't have an eye this or an eye that, you know, they get the G3, the G4, et cetera. People are buying those things. They're buying the tablets. Those kind of things I'd look at. I'd look at big pharmaceuticals. People are still trying to be healthy. So the pharmacies are putting new progress in the pipelines to get more medicines. Foods. Everyone's got to eat.
Right.
So those are the areas I'd look at.
Are you optimistic about this year?
Yeah, I think it's not going to be a banner year. There's still an awful lot of kinks to get worked out. You've got the housing market that's still scrambling around, and that's going to drag it a little bit, but people are saving more. You know, they're earning slightly more, but they're saving more. They're not going out and spending it on stuff.
What about the interest rates? Because the Fed had said that it's going to artificially keep the interest rates down through 2014, a year longer than it had originally thought.
Exactly.
How's that going to affect the economy?
Well, last year we went out of corporate bonds because we were anticipating rates were going to go up with inflation, but now we're back in corporate bonds because they're paying a high yield, and through 2014, that's a lot of time.
Yeah. All right. Well, it's a long year, just getting started. Pretty good month we had so far. Appreciate you coming on and sharing your thoughts with us.
Always a pleasure. Thanks.
Thank you very much.
Okay.